dependent on government expenditure, while timely and well-calibrated exit from exceptional fiscal measures were critical for macroeconomic stability. Policy focus on boosting private consumption expenditure and investment was the key. They were in fact the a key in reviving the economy on a durable basis. Now, I would just like to again touch upon what were the fiscal and monetary responses during the COVID-19 pandemic, which we are confronted with. The past 1 year has witnessed unimaginable misery and agony across the world, entailing large destruction of human life and wealth. Governments and central banks across the globe unleashed conventional and unconventional policy support to fight the devastating adverse impact, the negative impact of the pandemic. Globally, governments have unveiled large fiscal stimulus packages in 2020, amounting to nearly 14 trillion US dollars, 14 trillion US dollars, which is equivalent to about 13.5% of the world GDP. And this was done to contain the spread of the pandemic. And this is published, these details are published by the IMF in its latest report in 2021. Now, as a consequence of this, deficit and debt levels have increased across the world and across countries. In India also, the central government announced a series of economic packages, initially focusing on protecting vulnerable sections of society, followed by counter-cyclical measures to provide an impetus to consumption and investments for reviving and resurrecting growth. Central banks, on the other hand, had proactively designed and implemented various conventional and unconventional monetary policy measures based on their experience from past crises, notably the global financial crisis of 2008. And the proactive action and the intervention of central banks was visible across the world. Most central banks have lowered policy rates, widened the range of eligible counterparties, and eased collateral norms, while increasing the scale and tenor of repo operations. They also expanded their asset purchases programs to contain pandemic-induced elevated uncertainty and facilitate lower long-term interest rates. These measures were complemented by implicit and explicit forward guidance by communicating the stance of monetary policy going ahead. In India, the Reserve Bank undertook several conventional and unconventional measures in the wake of COVID-19. Now, other than the conventional measures, the Reserve Bank, as you would know, has undertaken measures like the long-term repo operations, the targeted repo operations to augment system as well as sector-specific liquidity. The Reserve Bank has also provided special refinance facilities to select all India financial institutions like the NABARD, SIDBI, and the National Housing Bank. Special liquidity facility was also provided for mutual funds, and that was done to ease the redemption pressures in the mutual fund segment of the economy. Unlike many other central banks, the Reserve Bank's asset purchase did not dilute its balance sheet and hence did not compromise on core principles of banking. These purchases were confined to risk-free, that is, I'm talking about Reserve Bank's asset purchase programs. The Reserve Bank purchases were confined to risk-free sovereign bonds, including state government securities, and the focus was to foster congenial financing conditions without compromising or without jeopardizing financial stability. Further, forward guidance also gained prominence in Reserve Bank's communication strategy to realize cooperative outcomes. Our commitment to ensure ample liquidity conditions supportive of recovery dispelled illiquidity fears in the market and bolstered market sentiments. We will continue to support the recovery process through the provision of ample liquidity in the system while maintaining financial stability. Let me now touch upon the impact of the pandemic on trade and balance of payments. The impact of COVID-19 induced deceleration on GDP and trade, if compared with the global financial crisis of 2008, reveals contrasting trends. Global GDP is estimated to have contracted by 3.5% during 2020, much higher than the contraction of 0.1%, which was witnessed during the global financial crisis of 2008. While on the other hand, global merchandise trade is estimated to have contracted only by 9.2% in 2020, as against a contraction of 22.3% during 2009. This differential pattern could essentially be attributed to the major role played by the domestic drivers across countries, induced mostly by lockdowns during the recent episode of the COVID-19 pandemic. Even though merchandise trade has shown incipient signs of revival since end of 2020, recovery in services trade is yet to gain traction as subdued cross-border tourism and travel restrictions continue to weigh in on overall performance of this sector. Uneven global recovery led by a few Asian countries and select sectors such as medical equipment and electronic products raises concerns regarding their sustainability. A crucial impediment to revival of global trading activity is the continued disruptions on global supply chains, with steep increase in shipping costs since November 2020 and lengthening of delivery times leading to rising commodity prices. These issues call for urgent attention from the policymakers across the world. The impact of demand and supply shocks is also reflected in balance of payments. And now I'm mainly focusing on the overall global picture, then I'll come to India. Now, the impact of demand and supply shocks is also reflected in the balance of payments. While commodity exporting countries faced lower current account surpluses due to negative shocks to their net terms of trade, net commodity importing countries such as India benefited, recording either lower deficits or even surpluses. Lower crude oil prices and weak demand due to COVID-19 related lockdown in the early days of the pandemic squeezed India's oil import bill by 42.5% during April to January 2020-21. In contrast to goods trade, India's net services exports remained relatively resilient, despite travel receipts and travel restrictions. And when I say travel receipts, I mean that despite travel receipts falling sharply due to travel restrictions. Unlike most of the other major economies, India's services exports of India gained traction from our software exports. Domestic information technology companies benefited from the growing global demand for core transformation services as their customers focused on new models for IT operations during the pandemic. Remittance inflows fell amid widespread job losses in host countries. Nevertheless, the decline in remittances was more than offset by lower trade deficit and robust net exports of services from India. As noted by the UNCTAD in a recent report of 2021, India's inward foreign direct investment, that is FDI, it bucked the global trend and grew positively in 2020, boosted by investments in mainly the digital sector. In 2020-21, that is April to December, net FDI to India at US dollar 40.5 billion was higher than 31.1 billion a year ago. India's optimistic growth outlook and ample global liquidity also induced net foreign portfolio investment of 35 billion US dollars in domestic equity markets in 2020-21 up to 19th of February. Non-residents also made higher accretion to deposits with banks in India. Consequently, the surplus on both current and capital account is reflected in buildup of foreign exchange reserves during the year. As on February 19th, 2021, foreign exchange reserves of India, that is RBI's foreign exchange reserves, were US dollar 583.9 billion, an accretion of 106.1 billion US dollars since end March 2020. The external sector outlook would continue to be reshaped by headwinds and tailwinds associated with both domestic and global recovery. Now with this background, let me turn to some emerging post-COVID opportunities in India. I would now like to focus on certain emerging post-COVID opportunities in India, for which I have listed out 7 key areas for special mention. The first one relates to manufacturing and infrastructure. The manufacturing sector is spearheading the growth recovery as many contact-intensive services subsectors are severely affected by the crisis. The initiatives of the government under Atmanirbhar Bharat Abhiyan and the Union Budget 21-22 towards developing a vibrant manufacturing sector and infrastructure acknowledges the strong linkages they have with rest of the sectors. The production-linked incentive, that is PLI scheme, aims to make India an integral part of global value chain. This, along with reforms in labor market, can go a long way in propelling growth to an elevated trajectory for the manufacturing sector and reap its employment potential in India. The second area I would like to highlight is the micro, small and medium enterprises, the MSMEs. I'm happy to note that MSMEs, that is small and medium enterprises in particular, account for about 2/3 of the current membership of the Bombay Chamber of Commerce and Industry. The micro, small and medium enterprises, that is MSME sector in India, has emerged as the growth engine of the economy with a vast network of about 6.33 crore enterprises contributing 30% of our nominal GDP and 48% to exports. This sector employs 11 crore people, second only to agriculture. The sector has been rendered especially vulnerable by the pandemic, necessitating concerted efforts to combat the stress and focus on revival of the sector. In this regard, 2 major schemes, that is the Emergency Credit Line Guarantee Scheme, ECLGS, and the Credit Guarantee Scheme for Subordinate Debt, were introduced by the government. These have been duly supported by various monetary and regulatory measures by the Reserve Bank in the form of interest rate cuts, higher structural and durable liquidity, moratorium on debt servicing, asset classification standstill, loan restructuring packages, and CRR exemptions on credit disbursed to new MSME borrowers. As you know, for the MSME sector, even before the pandemic, on 1st January 2019, we had announced a major restructuring scheme. And once the pandemic set in, we again announced a scheme which said that assets which were standard assets as on 1st January 2020, that is my recollection, they also became eligible for a restructuring. These measures will not only help in ameliorating stress in the sector, but also open new opportunities. Going forward, the Reserve Bank stands ready to support the Small Industries Development Bank of India, that is the SIDBI, for greater credit penetration to the MSME sector. The third area I wish to highlight is technology and innovation, and this is again an area where I think the small units and many medium and small size units are playing a significant role and are gradually making their presence felt. Digital penetration in India has scaled a new high. The time has come to leverage its applications while at the same time strengthening the digital infrastructure. With approximately 1.2 billion wireless subscribers and 750 million internet subscribers, India is second largest and one of the fastest growing markets for digital consumers. Digital capabilities As digital capabilities improve and connectivity becomes omnipresent, technological innovation and technology-driven revolution are poised to quickly and radically change India's economy. They have the potential to raise the productivity of agriculture, manufacturing, and businesses, as well as improve the delivery of public services such as health and education. In the financial sector, this could lead to higher financial inclusion, lesser information asymmetry, and reduced credit risk. Similarly, open online courses, audiovisual training programs, and remote learning can strengthen the match between skills required by the industry and the skills imparted in schools, colleges, and technical institutes. Healthcare delivery can be improved via digitization of medical records, remote provision of diagnosis, and prescriptions via smartphones and mobile internet. Technology adoption in rural areas for precision farming by using geographical information systems based soil, water, and climate data to guide farmers' farming decisions, as well as using real-time market information to guide sale of agro products, can add high value to the agricultural sector. The e-commerce sector, with its lower cost of transactions, is already revolutionizing the market structure, culminating in deeper market integration. I would like to point out that gross domestic expenditure on research and development in India is mainly driven by the government, with a share of 56% of the total R&D in India. It is important for India to become for India to become a global technology and innovation leader, the corporate sector should take the lead, as is the case in many emerging markets and advanced economies. The fourth area I wish to highlight, and I would be now very quick, I'll try and conclude very quickly. The fourth area I wish to highlight is health, the healthcare sector. Post-COVID-19, the health sector has undoubtedly emerged as a major fault line, as well as the sector with tremendous growth opportunities. With a network of more than 3,000 companies, India now ranks third globally for pharmaceutical production by volume, with the sector generating a trade surplus of $12 billion annually. India now supplies more than half of the global demand for vaccines. The sector is expected to witness strong growth in the coming years with its commitment to R&D and low cost of production. It is expected to supply a significant share of increased global demand for vaccines and medicines in the post-COVID scenario. Going forward, the focus should be more on enhancing overall supply of health services at every level of value chain in a cost-effective manner. Corporate sector needs to invest more to create scale and skill in this sector. The fifth area I would like to highlight is export push. And again, as I mentioned, the MSME units, and I'm highlighting and stressing this point because you have large number of MSME, promoters of MSME companies who are your members. So with the global economy gradually emerging, with the global economy gradually emerging from one of its deepest recessions, global trade activity is also likely to get a cyclical upturn going forward. In the case of India, there has been focus on structural reforms that can set the foundation for robust growth and greater role of domestic industry in global value chain. Based on sectoral strengths and potential opportunities, the PLI scheme of the Government of India identifies a few champion sectors that will support domestic manufacturers in achieving economies of scale and expanding their footprint in the global market. The response from companies, particularly in electronics, pharmaceuticals, and medical device industry to this scheme, that is the PLI scheme, is reported to be very encouraging. This export push is likely to come from other sectors like food products, apparel and textiles, capital goods, automobiles and auto components, and electronics and semiconductors. Since the incentive structure under PLI scheme is envisaged for next 5 years, domestic industry needs to develop its strength by focusing on quality and export competitiveness in order to remain viable in the long run. The sixth area I would like to highlight is free trade agreements, the FTAs. Another policy area which needs focus for providing a durable push to India's exports and growth is the free trade agreements with key strategically important economies. The potential FTAs need to take cognizance of not only domestic strengths and global opportunities, but also the emerging geopolitical landscape in the post-pandemic period. While designing future FTAs, India's experience with FTAs can be a significant guidepost. Key considerations should be to identify countries and regions that not only have the potential as market for domestic goods and services, but also have the scope to enhance domestic competitiveness, that is domestic competitiveness of India, especially in sectors covered under the PLI scheme. The post-Brexit scenario offers a greater scope for having separate trade agreements with the UK and the European Union. FTAs with these economies can boost not only the bilateral trade and investment relations, but also may pave the way for greater collaboration in areas of scientific research and climate change. Due to favorable demographic dividend, Africa also offers immense potential for exports and investment from Indian firms. Large presence of Indian diaspora could help tap this potential. And finally, let me focus on, that is the seventh area, that is services exports. Recovery in world services trade, which grew faster than merchandise trade in the pre-pandemic period, is expected to be slower due to cross-border travel restrictions being still in place. There has, however, been greater emphasis on carrying out business operations with efficiency. This has increased the demand for cutting-edge software, services, and new business opportunities brought on by the ongoing global value chain reconfiguration. This has also provided resilience to software exports of IT companies. A recent study by the WTO, that is in February 2021, in the current month, estimates that by 2020, global trade growth would be 2% higher annually